today in multifamily in the US, the simple math is basically, you'd be developing to a stabilized 6 yield and you could borrow at a 7. And so it just doesn't work. It's very hard the viability is challenging. Whereas on the European continent, you can develop to late 5s or 6 and you're borrowing at a 4 or below. And so there, on a relative value basis, there's accretive debt. So that's made, I think, Europe especially compelling today. In London, the average salary would have to save for about 30 years to afford the average home. And so basically the calculus is you graduate from university and begin working, and by the time you can retire or are ready to retire, you could buy your first home. So it's kind of a grim situation. And the average time or duration that somebody rents has effectively doubled in the last 10 years. So the demand for rentals for that reason has gone through the roof.
Tom, welcome to the People Property Place podcast.
Thank you very much. Great to be here.
Not at all. It's a real privilege. So thank you so much for finding time in your busy schedule. I know you're not in London all that often, or maybe you are
more
actually.
Often than you would think. My family would wonder where I am if if that were true. So.
Yeah, well, quite. Well, you are. Yeah, you are based in Madrid, so
yes,
it's not too far away. But thank you. I know you're incredibly busy with lots of international travel, so it's great.
Yeah,
that you are
pleasure to be here.
Here in the studio. So I'm really keen to unpack a little bit about EQT Exeter and specifically kind of the living business that you lead over here in Europe. But before we get on to some of that good stuff, can you tell me how and why you got into real estate in the first place?
Sure. So yeah, I'll try to make a long story short. I did not come from a real estate family. So I came from a family of scientists. And I think that gave me an appreciation for the scientific method and kind of a comfort with experimenting with things, which I've kind of carried over. But I grew up on the Jersey Shore, and growing up on a barrier island, I think you get an appreciation for barrier islands. And if you know this, they migrate naturally. So there's erosion on one side and deposits on the other. And so anytime you build static infrastructure, roads, homes, they're meant to migrate, and you prevent them from doing that. And so it creates all sorts of interesting land use and economic issues, insurance, et cetera. So,
and real estate challenges.
So, there was that sort of backdrop that made me curious. And then also in New Jersey, you have places like Asbury Park, Atlantic City that, they had their heyday and were once kind of glamorous resorts and have fallen into disrepair. And now they're kind of in some cases resurging. And so it always kind of made me curious about what makes places thrive or not. So with that backdrop, I was in school and university and studied environmental science and policy, which was a kind of interdisciplinary course of study across economics and ecology and law and sociology. And so that was almost, without knowing it, unwittingly really kind of the perfect training ground for doing real estate development or investment. So I would say I had a lot of different early jobs. I mentioned to you before, my first job technically was actually an executive search. And then I worked in management consulting, and I had worked on a couple of startups during the .com craze, and then did a crazy sailboat project that we'll probably talk about, and worked in a steel factory. And but all the time, I was kind of had this idea in mind of real estate, and frankly, architecture and design were always of interest. And so finally landed on that as something that stuck.
So no family kind of
nothing
connections
whatsoever. No, my dad's a molecular biologist. My mom is a biologist and later nurse, and my grandfather was a chemist. It's doctors and scientists are throughout the family, and so I'm the black sheep.
Yeah, the black sheep. Yeah, maybe not too rogue. But you landed at Harvard, right? That's where you studied.
I did. Yeah.
And did that kind of open your mind up to real estate as a kind of a viable career as well, or?
I would not say that. No, I at the time I had no idea that it was a career really. And Harvard is not a school that I think holds out real estate as an academic discipline. I mean, some schools do, like NYU or MIT, Berkeley, but there was a real estate professor that I crossed paths with at some point. I don't know if you would ever remember, but Bill Porvu, who I admired at the time, and there wasn't a lot on offer that was real estate specific. Alan Leventhal was another professor there that had a big impact on the development of Boston. And so I started to kind of explore these things early there, but it was just kind of dawning on me that it could be a career. I wound up going into management consulting because it was, like I said, didn't really have much business background. My dad actually wound up starting a biotech company that he later sold, and I think somewhat unusually was able to bridge the divide between research science and business. And so that was kind of an inspiration to me to look at business. I thought I might do something entrepreneurial. I'd like venture capital or like innovation and sort of funding ideas. And so in real estate in a way is that kind of on rinse, wash, repeat all the time. You're always kind of innovating and taking on every business, or every building is a little business effectively.
Yeah, and there's a whole ecosystem in terms of how it's funded,
exactly.
who it's for, how it's managed, etc.
Yep.
As a kid growing up, what kind of kid were you? Clearly incredibly academic and bright, given the family genes, but also the school you landed at.
Yeah, so I'll tell you a funny story. I would say, not exactly what you described. So I was intense, and I think my parents would both vocally agree with that description. Where I grew up, it was a very small town on the Jersey Shore. So we had, I think it was about 15 kids in my grammar school class, and we were all friends. It was a town that was very seasonal. So you had the traffic lights would get turned off in the winter, and you could basically walk blindfolded across the main street and not worry about getting hit by a car. And so didn't really have much in the way of kind of comparison. And then I went to a private school, commuted to it for a couple of years in high school for the first 2 years. And when I got there, the end of the first year, I wound up being second in my class out of 250 kids. And it was, they called me up for an award at the end of the year, and I was like, that was interesting and surprising. I didn't expect it. I wasn't even sure I was going to get into the school to begin with. And then, so did reasonably well that year. And then the second year, again, was second in the class. And so I went to have a chat with the guidance office, and I said, so like the kids that are top of the class here, like where do they go to uni? And it was a all boys Catholic school, Christian Brothers Academy. And so they named a bunch of Catholic schools, predominantly like Boston College or Georgetown. And I said, what about the Ivy League? And they're like, yeah, we don't really send that many kids to the Ivy League. And I was like, well, let's see how far we can take this, and see if that might work. And so I went home and I called my dad and I said, so I think I'm not going to go back there. And he's like, you're out of your mind. You're doing well. Like, why would you not go back? And I said, if I continue on this track, this is where the kids that are in that position normally go. I think if I were to assemble my own academic program and kind of, it wasn't really homeschooling myself. I went to the local high school and kind of proposed this to them and got it approved by the Board of Education. Maybe that would give me a better shot at getting into an Ivy League school, and it wound up working.
Wow, that's amazing to have that foresight and drive and plan and initiative as well to
and serendipity. And it was a feeling that worked. It could have gone the other way.
Well, clearly you backed yourself.
Yeah.
So you did a few different jobs: management consulting, some headhunting, and then what was your kind of first real estate job?
So I had an internship at Low Enterprises between years at business school. So that was really the first time. And I thought when I was kind of had the idea to go into real estate that I wanted to do resort development or kind of hospitality. I loved the idea of creating experiences for people. And I really admired, for example, like Ian Schrager and like Morgan Hotel Group, and the idea of kind of bringing experience as a driver of value into places. And what I discovered, so I worked for both Low Enterprises has a private equity group, and then they had Destination Hotels and Resorts and Low Destination Development, LDD. And they're probably named different things today, but I got a chance to work with that group, and I loved it. I really enjoyed the team and what we were doing. But what I felt like was it was almost, when you're developing resorts, it's kind of like working in a nightclub with the lights on. So a lot of the sex appeal goes out of it. And just maybe with age, maturity, experience, I felt like the ability to kind of bring those kinds of experiences into and impact the daily lives of people was a little bit more interesting. So that was a little bit the kind of early experience that shaped my decision making, that led me to residential real estate. And then the other thing, to be quite honest, which is kind of funny, when I went to business school, I went with my wife, or she was girlfriend, fiance at the time, and in the first months of business school, we got married. She is from Chile, and when she arrived in the U.S., she didn't speak any English at all, and it was a fairly challenging 2 years, you could imagine, at business school, like living with somebody on campus in a small campus apartment where I'm quite busy and trying to be social and do all the academic and social stuff there, and she's unable to speak English, and so we had it was a challenging couple of years. And when I was thinking after graduation, like, what do I want to do? I thought, if I go to a very intense job, like at a investment firm in New York or even LA or something, or Chicago, the likelihood of this relationship surviving is low. And so I was trying to think creatively about where we might be able to go that would give us a chance. And a company came on campus to recruit, and they were looking for somebody to run a development project in Monterey, California, which is a pretty sleepy part of the central coast of California, about 2 hours south of San Francisco. We got to live in Carmel by the Sea, and it was, I think, the best kind of personal decision I've made for our relationship, because we're still married after 21 years now or so, and so yeah, that was a good call, and it was actually serendipitously a great call from a timing perspective in real estate, because I got out of business school in 2006.
You were at Stanford.
I was at
business school.
Stanford.
You were doing your MBA there, right?
Yeah.
With a real estate weighting, or was it?
I took all the real estate classes I could. So, I mean, there were a few on offer there. I took some law, but I mean, it's a general kind of course of study. So it wasn't, you could go to some MBA programs actually have a real estate track. Like I was involved in the real estate club and did everything as much as I could kind of real estate related. I had two amazing professors in real estate, Doug Abbey from AMB that later sold into Prologis, and Joel Peterson, who our paths have crossed many times over the years, because he's very close to Greystar, where I spent some time. So I got very lucky with kind of those mentors, but there wasn't like a real estate track per se.
Fun.
Yeah, but I was going to say, when I got out in 2006, that was on the eve or precipice of the GFC, and so the opportunity that I had found was to lead the development of a military housing project that was kind of uniquely Army and Navy both had bases. There was the Defense Language Institute for the Army and the Naval Postgraduate School for the Navy, and they needed loads of housing, and there was a kind of privatization program by the DoD in the U.S. to improve the housing. And so I was developing 2,200 homes across these two military bases. And when the GFC came around and the world went upside down, I was clipping along,
I bet you were. Government mandate cracking on.
It was just,
nothing stopped.
It was as if nothing had changed. So, I mean, and that's not entirely true, because like my task was to use that military project as kind of a launch pad to get other things going. And I had a partnership with General Growth Properties, and they later went bankrupt, and that went sideways. And there's a number of things that did sort of on the periphery fall apart, but like my main job was quite stable, and I was very fortunate that I wasn't as affected as some were during that period.
So it kind of took the personal relationship piece, just in terms of
my wife has saved me like that a number of times.
But also saved you, rather than winding up at an aggressive PE shop and maybe not being there when the fan really hit.
Exactly.
So you were there. You ended up being there for nearly 10 years, if I'm not mistaken.
That's right. Yeah, but the number of different things that I did there, it was like I had probably 12 jobs in 10 years. So I did lots of different things. I mean, I did the military housing project in particular. It's a public-private partnership with the military, and there's a 5-year kind of development period, initial development period, and then you manage for another 45 years or so. So I was really focused on the first 5 years, and we lived in California and got to do the development. And then I was really looking at, and this was kind of straddled the GFC, so it was 2006. By 2011 or so, there was the aftermath of what had happened, and I had identified some interesting opportunities that arose from that. One, as a consequence of the GFC, you had all of the monoline insurers went bankrupt, like Ambac, and we had all of these projects for the military were financed with bonds that were all wrapped with insurance and AAA rated as a result. And suddenly those insurance wrappers were worthless, and all the bondholders did not understand what the underlying credit was. And so I was incubating a strategy to go out to the market, and the spreads blew out by like 1,000%. And so the idea was to go and raise money to buy those bonds back at 1,000% wide, and bring the spreads in, educate the market, and resell them at 200 to 300 basis points over. And you capture 700 or 800 basis points of spread compression on that. That's like very valuable.
Yeah.
So I had begun working on that. We had a broker dealer within the organization, and we were incubating that, which unfortunately for a host of reasons didn't come to fruition. But I wound up taking over the broker dealer as kind of another step in that journey. And I had brokered some investments into startups. We had a seafood trading platform that we were incubating. I was trying to parlay the military housing experience into university housing and do on-campus housing for universities, and started a relationship between Clark, is where I was, with EDR, Education Realty Trust. And this is, the world is a funny place, right? So I began that relationship between Clark and EDR, and we were pursuing some student housing deals together. Fast forward years later, Greystar took EDR private and folded it into Greystar. And so some of the people that I had known at Clark when, early days of student housing, 2009, it was probably 2018, 2019, EDR 10 years later became part of the place that I was working. We saw each other again. So,
power of the long game, and
exactly,
just how closely related people can be in companies, and given changes in the market and mergers and acquisitions. So you moved to Boston Andes Capital after a period.
Yeah. So the story there is kind of as a result of the GFC, and development at that time just kind of died in the U.S. And I was a developer, and so yes, I had the military housing project, but I was really sort of eagerly looking at what else can I do, full of energy, ambition, and some of the things that I had been working on, like I said, went sideways. We also had this strong relationship with the military. So vis-a-vis the U.S. government, I got introduced to a agency of the U.S. government called OPIC, the Overseas Private Investment Corporation. It's now called the DFC, the Development Finance Corporation. And they operate a little bit like the IFC or the World Bank, basically trying to support private investment in furtherance of U.S. foreign policy interests. And they had a priority at the time, and I think probably still do, of looking at Central America. They call it the Northern Triangle. It's Guatemala, El Salvador, Honduras. And one of there was, for a variety of reasons, those countries, there's limited resources. They have quite a bit of crime. At the time, there was the place that we wound up working in, Honduras, was the murder capital of at least the hemisphere, at least outside of a war zone. So dangerous places, organized crime, lots of, as a result of that, immigration into the U.S., often illegally. And so the U.S. was looking at how can we help stabilize these places and give people a reason to stay. And one of the ideas was to create safe communities and a path to home ownership. And so we began, in conjunction with the U.S. government support, building these large-scale communities in Honduras and Panama eventually, and we had looked at some in El Salvador. And the idea was to give people a path to home ownership. So we were there was no mortgage lending to especially the people that we were aiming to put into these homes and get on that path. And so we created a kind of synthetic mortgage that was done through a lease purchase structure. So it was a 25-year lease with a dollar purchase option at the end. And the intent was to have these people become homeowners after 25 years.
And get out of the drug trade or whatever trade.
Yeah, or just to we created we had a partnership with Google, and Google was creating these bilingual schools with advanced technology like the smart boards. This for a public school in kind of, a not wealthy area of Honduras was pretty striking. And we brought in loads of services, bus routes, commercial areas. We gave people funding to even start little businesses. And our kind of our philosophy about this was to build out all of the infrastructure. So potable water, paved roads, electrical system, water treatment for sewer, and the houses we kind of lightly finished, and allowed the people then to kind of continually improve and finish the houses themselves. One thing led to another, and the projects didn't wind up working as for sale projects. They wound up working more as rental projects. And I kind of unwittingly fell into having to create a property management organization down there. And I think it was one of the first property management organizations like that in Latin America. And it was kind of by accident. And we stuck with this for a long time, but eventually that was not kind of the business that we realized we wanted to be in long term. And so I was asked to find a way to exit this. And it was probably, we began in 2008, and it was around 2000, probably 6-7 years later, that, Clark or CRC was looking to turn the capital. And so I went out on a mission to try to find a buyer. And so I met the folks at Boston Andes, and there aren't many people that would entertain buying, a operational housing project in Central America. And I was led to, Boston Andes because they had bridged capital between the US and Latin America, and they had done deals in both places. And we got to talking, and they didn't wind up buying it. But the founder of Boston Andes wound up bringing me in to, he said, why don't you come work with us instead? And that was an interesting, I wasn't there for very long because I had begun some other conversations in parallel. And the idea with Boston Andes was to see if we could use this as a platform to scale. And I don't think that was something he was that interested in doing. And so, it became pretty apparent quickly that
wasn't there.
Yeah, exactly.
So you landed at Greystar.
Yeah. So Greystar, I don't know when the last time was, I don't know if what you would think about this as a recruiter, but when the last time was that I actually went through a formal recruiting process, probably coming out of business school, because at Greystar, we had begun to get to know each other when Greystar had gotten a call from PGIM or Prudential to go to Mexico and work with them on some assets there. And the folks at Greystar hadn't done anything in Latin America before, and they found their way through some mutual friends to me because I had unwittingly built this property management organization in Central America, and we had begun talking and just comparing notes and helping kind of on a friendly basis. And then the team that was set up there in Mexico for Greystar, some of them left to go start their own thing, and there was sort of an opening of opportunity. And we began a conversation again, and they said, would you be interested in going to Mexico? And I had just, my second daughter was born. I was living in Massachusetts, and I was not thinking about going to Mexico. And they said, where would you choose to go if you wanted to do something in Latin America? And I said, I would go to Chile. And so they said, that's odd. Why Chile? What's there? And so I explained actually that when I was in Chile, I wrote my business school application essays about the rental housing market in Chile because it was fragmented ownership. It was, all of the things that, probably the U.S. was 40 years ago. I saw there. It's just kind of substandard product, no service whatsoever, fragmented ownership, and relatively cheap. The housing was like 14% of an average income. The average rent was the 14% of average income. So the idea that I had written about in my essays was you could deliver a better product, deliver a better service, charge a little bit more to make it economical, and it would still be affordable to the people. and you consolidate ownership and professionalize this and drive in liquidity and everything that, frankly, Bob Faith kind of innovated in the U.S. with the multifamily industry. I thought like just the opportunity was staring me in the face. So I described this in brief, and they were like, "Huh, why don't you come down to Charleston and tell us about this?" And so I went down there and I spent a few days in conference rooms with them, and at the end of it, Wes Fuller, who I don't know if you've met him, but
I haven't.
yeah, he's a great guy, but responsible really for the scaling of Greystar outside of the U.S.
Yeah.
He sort of laughed and he said, "It's crazy. Like, we're gonna send you down there and see what happens." And so I was given a laptop and and a pat on the back and sent to Santiago, and I set up in a Starbucks and yeah, that's how I got there.
Got opening your Spanish book. To
by
learn the language.
that time, I mean, I better have spoken Spanish because I told you before, my wife at Stanford didn't speak any English. So if I didn't speak Spanish, that would have been interesting.
And is your wife from Chile?
She is, yeah.
So hence the Chile piece. It kind of,
Yeah.
your wife had been in the US for 10 years or so. This is an opportunity to bring her and your two daughters back to Chile to spend time with her family. But clearly there's also a very clear business real estate opportunity as well.
So the funny thing is when I shared this idea with her and I said, I'm having this conversation and it looks like there might be an opportunity to go back to Chile. And she said, "You're crazy. Like, you did not like living there." And it's true. Like when I was there, when I got to know her, I lived in a place that was, it would be, well, I don't want to disparage any places, but it was a very industrialized, not very attractive place. I didn't have any money. I had just plowed all the money that I had into this crazy project that we had done to sail a primitive boat across the Pacific. I mean, this is another story. And so it was not a very pleasant experience. And I was very happy when we got to go back to the States. And so she's looking at me like, "You're not going to be happy." And I said, "But you have to understand the opportunity here is so interesting. Like, this is a once in a lifetime thing. We've got to do it." And I went there. And when I left 6 or 7 years later, that perspective completely flipped. So I absolutely loved living there. We had an amazing time. We had some incredible friends. Like the whole situation, we really, really liked it. The opportunity I saw over that time just sort of drift off and die.
Because?
I don't want to say it died, but it got significantly less attractive because, so we got there in 2017, and in 2019 there was social unrest in Chile, and the 30 years prior, Chile was a rocket ship. Like, it was outperforming on every single metric, and this is one of the reasons why when I went originally to propose the idea to Greystar, I said, like, this is just so interesting. Like, it's not the biggest economy by any stretch.
Very
in Latin
rich
America.
in terms of copper and other.
Well, it's rich,
resources.
but it's also rich in terms of GDP per capita. And it's, when you look at GDP per capita, when you look at literacy rates, potable water coverage, infant mortality, it's like literally every metric, life expectancy, the country had outperformed head and shoulders above any of its neighbors. And it was a very open economy. It had the most free trade agreements of any country in the Western Hemisphere. I mean, it was really firing on all cylinders for 30 years. And this kind of wave of social unrest erupted in Chile. They call it the estallido social. It's like the social eruption. And I mean, from one day to the next, like Santiago was literally burning. Like the people that were rioting burned metro stations, and it was quite an orchestrated thing where they attacked sort of like food supply lines, gas stations,
Wow.
metro stations. So it wasn't haphazard or as organic as it might have appeared. And then there was question about whether Chile was going to tear up and redraft its constitution. And then from that, we went into COVID. So through that time, you just had capital fleeing the country. So local capital was, a lot of private wealth. I think it was to the tune of, I don't want to get the number wrong, but it was a significant volume of capital that left the country. They also tapped into the pension system and the forced saving systems to subsidize during COVID. So rather than kind of take on new government debt or whatever, they basically just gutted the pension system. So they allowed early withdrawals. And the pension system was like a huge engine of growth for the country. And so there was, on a number of different sort of levels, you just saw a country that had been on this 30-year trajectory of extraordinary growth and success turn a sharp corner, and capital no longer wanted to be there. And I think Sam Zell was famous for saying value equals liquidity, and the liquidity just totally dried up. And so I was struggling to try to find, we had to use local capital in the beginning, and then we tried to get some foreign capital down into the region, and they were dipping their toe, but it was a little bit of a wait and see approach. And then this all happened, and that approach became, let's just wait.
Yeah.
We've seen.
Yeah.
And so I think, it's a tough, because the opportunity fundamentally still exists, but the context has made it very challenging.
Yeah. And your wife was like, I told you so.
Yeah.
I could see all of this coming. There's a reason why I left in the first place and went to the US.
I mean, I've tried this in a few different places. I've worked now across 11 countries, and I think it's really opened my eyes to how important liquidity is, and how important stable government is, which makes me very happy to be in Europe today, actually.
So you moved to EQT Real Estate in Madrid.
Well, so EQT, there's a funny kind of history to this too. So EQT Real Estate acquired in 2021 Exeter. And I had also had a conversation and sort of knew for a long time Ward Fitzgerald, who had started Exeter. And we had maybe, I don't know, 12 years ago, 13 years ago now, we had begun a discussion about me potentially joining him in the U.S. to start his a multifamily group for Exeter in the U.S. And there was another guy that I had worked with for 10 years at Clark, who went over and did that. And I wound up instead having the opportunity to go to Greystar, and for personal reasons and a host of reasons, that was the more exciting thing for me to do at the time. But Ward and I had kept in touch over the years, and after he sold Exeter to EQT, he came back around and said, we're looking to scale up the residential business in Europe. Would you be interested in doing that with us? And this was right around the time where I was sort of having this, I don't want to call it a crisis, but sort of a moment of doubt. Yeah, a moment of doubt myself of like, this opportunity that I saw in Latin America is not the same as what I expected. The whole landscape has shifted dramatically. What next? And so Ward kind of calling up and introducing this possibility was, it was like divine providence, basically. Yeah. And so I said, yeah. I mean, if you're serious, I will seriously think about it. And as I kind of studied the opportunity in Europe, I noticed there were a lot of parallels. Originally, so EQT is a Swedish firm, and I can tell you a little bit more about them. I don't know how much you know, but
yeah, I know a fair bit, but there'll be people listening to this who don't know. So a bit of context and a bit of
I'll come back to it.
Would be useful because it's a massive global platform.
Yeah, it really is. It's an incredible place. But so EQT is Swedish. It's headquartered in Stockholm. The center of gravity for real estate is really London. So the conversation began with, there's this opportunity, and you would naturally go to London. And in conversations at home and, kind of thinking through it, I said, I'm not sure. Nothing against London. I spend more time here probably than I do in the office in Madrid. But, weather-wise, cost of living-wise, and we, as Spanish speakers at home, maybe Spain, is that a possibility? And Ward said, yeah, we've got offices in Madrid and Barcelona. And so it was a very easy decision to say, Madrid is a wonderful city. It's really, I think, probably one of the maybe not anymore. I was going to say it's one of the underrated capital cities of Europe, but I think it's really kind of come into its own too and has taken off like a rocket ship. But Madrid is an incredible place to live. Would it be helpful to go back to EQT and talk a little bit about? Yeah,
very much so. Just to kind of, set some of the background, size, scale, what the group does, because it's not just real estate.
Right. So the roots of EQT are really in private equity. So it was founded as a kind of collaboration, I guess, by the Wallenberg family, which is a family of Swedish industrialists, and with a more than a century-long legacy, and some of the most prominent companies out of Sweden were founded by and grown by the Wallenbergs. And Connie Johnson, who kind of got together with the Wallenbergs a little over 30 years ago and had this idea to take all of the kind of the good business sense and success that the Wallenbergs had as being kind of active owners and the ability for them to drive value through these companies and invite other investors, institutions to come in and leverage that and scale that up through private equity. And so that's what they had done in the beginning. And that eventually, to that they added real assets and first infrastructure, and then real estate was the kind of last leg of the stool. And so the philosophy of EQT is really kind of, first of all, rooted in Nordic values, and it's what I had done some diligence before I agreed to move my family across the globe and come over here, and wanted to make sure I knew what I was getting into. And EQT enjoys a reputation of being good people, which in our industry is not always the case. So that's great. The values are basically transparency, respect, informality, which is an interesting one. But it's basically just the ability for any good idea to percolate to the surface, and there's the sort of hierarchy or layers of construct that some places might have are just out the door, and anyone has access to anyone. So that's really important. Entrepreneurialism. Those things are, I think, lived every day, and we've looked at different ways to kind of take those values and scale businesses. At one point in time, we had a credit business, and it's a business that we actually exited because we didn't feel like it was a place where we could roll up our sleeves and really actively add value. It was more passive as a lender. So I think they've really stayed true to, and even though credit in recent years has been booming, I think there was a discipline around, this is what we do well, and this is what we want to lean into. And these things over here, we're not going to just chase them because they're bright and shiny today. And then on the real estate side, that takes on a little bit of a different life or meaning, because there's capital allocators that really work through in joint venture with local operators, and you have different joint venture structures where you're paying fees and promote to local operators. That was not a model that they really wanted to pursue, because again, you're not in an active ownership and kind of hands-on role. And so, from an economic standpoint and also from a kind of philosophical standpoint, they wanted to build out more of a property company or more of a hybrid, and like being local in all of the markets that we were investing in is like a core tenet of what we do as well. And so I would describe it as kind of, if you think of a Venn diagram, you have like capital allocators on one side, and then you've got the local operators on the other side. We kind of occupy this space in between. So we have this broader perspective across the region, but we also are able to, and have the resources and structure to kind of get hands-on in all the markets that we're in. And we're doing direct deals. We're not working through partners. So that's kind of the evolution of the real estate company.
It's kind of vertically integrated, a fair term, or is that not a term that
it is?
That you like the sound of, or kind of fits the
it's a term that's bandied around a lot. I would say in logistics, that's absolutely true. So we've also kind of landed on two core themes, which are living in logistics.
Yep.
And it's a bit easier to be vertically integrated in logistics. I mean, logistics, you're effectively, we do all of our own leasing in logistics, and being close to the tenants and kind of anticipating their needs and having those direct relationships and conversations is a competitive advantage. There's a lot of value embedded in the lease negotiations in logistics, and you're effectively creating kind of like long dated credit instruments.
Yep.
In living, it's a B2C business, and the operations looks just completely different. And so being vertically integrated in living is quite a bit, it means something different. And so what I would say is, or what I've kind of repeated over and over again, is we are vertically integrated, but not to a fault. And, having come from a place like Greystar, which is fully vertically integrated in the living sector, and every person who is signing a lease or changing a light bulb is part of Greystar. In our case, I really want to keep having the opportunity to kind of clean slate, design this from scratch. What I saw was an opportunity to say, okay, like let's have the expertise in house to know how to drive value. But we don't necessarily need to build out all the machinery and make a big upfront investment in becoming a property manager. We can work through and leverage the scale of others. We just need to know what we want them to do, make sure we can hold them accountable to doing it. And that allows us to, I think, stay more in the role of a fiduciary and keep the focus more on being an investor than an operating business.
Yeah, it makes a lot of sense. Property is a people business, hence the name People Property Place. Business has been tough the last couple of years. Get the people aspect wrong, business becomes impossible. Get the people aspect right, it's still hard, but it's manageable, much more enjoyable, and you're much more likely to hit your goals. So if you're looking to add top talent to your team in 2025 and you're open-minded to an alternative approach and you're keen to make business a little less hard, drop me a DM. I'd love to have a conversation with you to see how Rockborn could potentially help you with your human capital requirements. Right, let's get back to the podcast. So give me the overview of the kind of the living business at EQT Real Estate, in terms of size, scale, where you operate, type of product, etc.
Yeah, so we have a fund that we recently finished investing. We invested about 800 million across Europe. So we're really one of the very few pan-European, like truly pan-European value add living players. So we like I said, we just finished investing about 800 million into the space. We have 72 buildings, a little over 11,000 units across 5 different countries, and local teams in all those countries. We have a variety of different strategies, but basically across the investments that we've made today, we have predominantly student housing, which we had in the UK, Spain, and France. We have regular way apartments in the UK, in France, in Sweden, and those are the strategies that we really have kind of leaned into. And so we have, the go forward strategy is really kind of rooted in what's worked best that we've seen, and almost more of a back to basics. Because I think today where we are in the cycle, it's there's abundant opportunity. There's a scarcity of capital. As an example, we had investment teams in Germany for a long time, for years, and we never pulled the trigger and were able to do anything in Germany because just couldn't make value add returns work. If you're underwriting, with some realism, I think it was very difficult. And today, that window of opportunity has opened in a meaningful way. And so we're glad that we made the investment in keeping the teams there. But we see a lot of opportunity in Germany today, which is probably the most different thing from what we had done previously. And we always wanted to be in the German market. We just couldn't crack it. But yeah, so that's kind of what it looks like. We're excited about the market today. I mean, I think we're going to be both, for the investments that we've made, soon entering into kind of harvest mode. We actually sold our Spanish student platform at the end of last year. So we're starting to think about exiting some of these things, and at the same time looking to put together some new capital to continue to scale the strategy. And I think there's the opportunity today to acquire is very interesting. And
is it typical kind of 3-year investment, 7-year hold kind of value add fund cycles, or is there a bit more of an evergreen type structure just given the values and ethos that?
No, a little bit the opposite actually. So the first iteration was kind of the typical structure you described. The next bite at the apple is actually much more tactical and compressed. So whereas, because of first of all, our investment period for the prior vehicle ended about a little over a year ago. So we've been, for the course of a year, kind of assembling pipeline. And because there's been very little transaction volume in the market, like fortunately, a lot of that pipeline remains viable. And the opportunity that we see and sort of the repricing that's occurred across the region, to the tune of, depending on the market, 100 to 150 basis points of spread or yield. So I think, ultimately we'll probably also evolve other products and have more of a core plus that's evergreen or something. But today we're focused on value add, and today it's, because of the moment in time that we're in, it's quick and tactical. We describe it as like the speedboat strategy.
And in terms of type of product, it's kind of light amenity.
Yeah.
Give me a little bit more, expand on in terms of the types of deals that you kind of look for and the characteristics that would be an EQT real estate living play.
Yeah. So this is a little bit kind of the learnings that when I was in my previous life, kind of taking what was successful in the US and figuring out how to adapt that to Latin America, which is a very price sensitive market, and still arrive at an institutional product that people could pay for, where they wanted to live. I spent years, trying to figure out, like, how do you spec these things? How do you design them? What kind of spaces? What kind of amenities, if any? What are the locations? And all of that learning maps incredibly well to Europe. So basically, we're focused on urban locations, sometimes suburban commuter towns, but always with a very close access to transit. So we want to have a train station or a tube station, a metro station within a 10-minute walk. And what we're able to do when you because of these kind of close-in locations, you don't need a lot of amenity on site. Like when you look at the U.S. multifamily model, I think it's very facilities focused because it's a little bit necessary, right? You have cities are, in a lot of cases, they're quite sprawled. And sometimes in the location of these projects, it'll be a 10 or 15-minute drive to the supermarket, right? Whereas in European cities, everything is quite walkable. And the amenities are the surrounding area. And you want to have proximity to transportation, like I said, proximity to green space, proximity to good schools, proximity to a high street with all of the services that you might otherwise try to incorporate into your projects. And so we don't have much amenity, if any. We'll look at sort of the surrounding area and say, okay, maybe strategically we'll add one thing here or there because it's absent in the context, but we really don't want to have a lot of many, if any at all. And what that does is it lowers your upfront investment, right? And you don't have all that amenity space that you then need to amortize over a certain volume of units. So like a highly amenitized scheme, the kind of minimum efficient scale depends on the market, but typically around 250 units. If you don't have all that amenity, you can get to a minimum efficient scale of about 100 units.
Oh, wow.
And what that means is, you can imagine this, right? If you look at London or Madrid or Paris, the universe of opportunity to find sites with 100 units is exponentially larger than finding sites with 250 units in these cities. And so you just have a much greater universe of possible projects. You're able to find better central locations for these projects. And the other thing that happens is you don't have to staff and manage and heat and cool all that space. It's about as close as I would say we can get to a secret sauce or magic formula is, you lower your upfront investment, you operate to a higher margin and achieve a higher yield and a higher return for less risk because you're tapping into a deeper part of the demand curve. So it's like higher return for lower risk has been our mantra, and it's worked really well.
It's like win-win-win all around.
Yeah.
And I guess the demographics are changing as well. I've read some of your pieces on the website, and one of them is, over in the UK, kind of home ownership around 34 years old, but also just that kind of generation, not viewing home ownership as a wealth bank or as a wealth generator, and actually it being more investing more in stocks and shares and kind of maybe more liquid type assets, but also valuing the flexibility and ability to kind of travel or fleet of foot in terms of change roles.
I think priorities have shifted quite a bit, and that against the backdrop of also a assortment of investment products that have been introduced to the market and innovations in that regard. So you have a lot more opportunity to invest in different types of products today and build equity in different ways. And I think there's an economic component to it, right? Which is, even if you could buy, what is the highest and best use for my capital? And is it locking it up in a home where I might also have unfunded liabilities? You have to do maintenance, and often people don't take these things into account. Or is it investing into this massive suite of possible investment products, whether it's accessing mutual funds or ETFs or, there's EQT is actually making a big push into private wealth right now, and through distribution channels like in the U.S. registered investment advisors, and there's more and more access to alternatives that I think are really interesting, to build sort of an investment portfolio that is diversified. And so I think there's the economic component. There's another element to the economic component is affordability. Like the average in London, the average salary would have to save for about 30 years to afford the average home. And so basically the calculus is you graduate from university and begin working, and by the time you can retire or are ready to retire, you could buy your first home. So it's kind of a grim situation. And so I think what we've seen is the average age of the first-time home buyer, for a combination of factors of preference and economic necessity, has gotten older and older. And the average time or duration that somebody rents has effectively doubled in the last 10 years. So whereas before somebody was buying a home at 28 or 27, now they're buying a home at 36 or so and 35. And when you from uni to 27, 28, you've got 6 or 7 years. And now you've added another 6 or 7 years. So you've effectively doubled the average time that somebody is renting. So the demand for rentals for that reason has gone through the roof. And it's only, the gap in affordability is only worsening. So, I sometimes joke that we could build housing, full tilt, as much as we possibly could for the rest of my lifetime, and we wouldn't solve. Across Europe, there's just like an incredible structural supply-demand imbalance, which is problematic. And I think municipalities, boroughs, federal governments realize this, and there's housing targets for a reason, but they're perpetually missed. It's a really complicated problem. I think there's a lot of room to run for the rental market here, which makes it especially exciting.
So there's the opportunity, but what's the kind of capital saying? Is capital showing up, or is it showing up for particular managers, or does it still need some more kind of reassurance?
Yeah, so I think it depends on kind of where on the risk spectrum. So we've begun to see core plus capital come back into the market. I think there's you probably hear this from everyone who's here and elsewhere in the industry, but there's been a bit of a bifurcation or flight to quality. So, there's a finer appreciation for higher and lower quality real estate and a differentiation between those things. As an example, when we sold our Spanish student portfolio last year, we hadn't planned to sell it. We were approached off market and kind of expressed little interest in engaging because we had, at the time we were approached, we had 3 of 12 assets operating. So that is just way too premature. And there's a lot more value to be created. And there was a kind of persistent conversation, and eventually an offer that was put in front of us that was attractive enough to get our attention and engage, and we wound up transacting. And I think that was an instance where we had what was truly best in class in terms of locations, in terms of asset design and spec. And so it was just something that the buyer wanted. So I think that's on the one hand. On the other hand, if you have, kind of uninstitutional, obsolete stock, like, you're going to have a really hard time selling it. So there has been that bifurcation. I think globally, what we've been hearing is Europe has really come into favor among global institutions, because the U.S. politically is a little bit more uncertain, and Europe has I think kind of shown a little bit in terms of stability. And then the other kind of core piece of the equation is, today in multifamily in the U.S., I mean, the simple math is basically, you'd be developing to a stabilized 6 yield, and you could borrow at a 7, and so it just doesn't work. It's very hard to, the viability is challenging, whereas on the European continent, you can develop to late 5s or 6, and you're borrowing at a 4 or below, and so there, on a relative value basis, there's accretive debt. So that's made, I think, Europe especially compelling today. I think the UK has had some viability issues for some of those reasons as well, and I don't know that the sort of expected rate cuts in the UK are kind of fully priced into the market today. So I think that there are some interesting opportunities today in the UK but we don't, as a kind of firm and philosophy, we don't really like to bank on rate cuts to save us. So we're pretty asset in the way we look at things, and want to make sure that there are layers of cushion. I think the way, particularly because Europe is such a it's such a patchwork of jurisdictions, economies, languages, currencies in some cases. I mean, there's a lot of regulation, of course. So the way we try to address that is through a mix of experience in the local markets and knowing how to navigate things. And if you have done it before, you can kind of develop the cheat codes for not cheat codes, but like the shorthand for how do you navigate some of these systems on the one hand, and on the other hand, build in contingency in multiple places all the time. So, we don't want to underwrite. So it's all the stars have to align to, hit the underwriting. It's like we underwrite so there is genuine upside, along with the downside.
You've been quite vocal around the middle income kind of earners, squeezed middle. Can you just elaborate on what you mean by that and where the opportunity is as well?
Yeah, sure. So, when you look at a graph of incomes, it's sort of like a bell curve with a long tail at the high end. What we see is there's really, on either side of the graph. On the one side, you've got kind of roughly 40% of the market that qualifies for some form of subsidized or social housing.
That much?
Yeah.
40%?
They qualify. They don't necessarily get it, because not everyone that qualifies is able to access it. But it's about 40%. In the UK, it is 41%.
That blows my mind.
Yeah. And I mean, in different markets across Europe, it's more or less the same. So you look at this graph and you say, okay, on the low end, you've had about 40% that qualify for social housing. On the high end, you've had about 10% that qualify for, or would qualify for being able to buy their own home. Right? They have enough, they earn enough, they have enough in savings.
It's only 10%.
10%. And then you've got this middle that's roughly 50% that can't afford to buy their own home. They can't qualify for social housing. And so we call it the missing middle, not because the people are missing, but you've had on either end product developed for social housing and product developed for the high end, sort of highly amenitized luxury product that the top 10% can afford. But the middle has really been overlooked. And the product that's available to them is typically older, obsolete housing. When I moved here, I had some friends say, like, that's so this romanticized idea about moving to Europe. Like, it's so lovely. And I said, it is, but you have to remember, like, the old world charm it sort of manifests in housing that has drafty windows, often no elevators or extremely tight elevators, no closet space, poor insulation.
Yeah, it gets really hot in the summer, really cold in the winter.
Yeah, I mean, it's just there's a lot of obsolete, most of the stock across Europe is built before 1980. And now with the EPC directives at an EU-wide level that are being kind of implemented in different countries at different times and different ways, those units are actually being legislated into obsolescence. And so you've got a situation where you just don't have modern, high-quality rental stock for this middle market. And that's where we see the opportunity. I think that middle market is only growing in population and in size, because the ability to afford a home is today, it stands at around 10% of the market, and that 10% is diminishing, and those people are being added to the middle because you've got a situation where people are renting for longer and sometimes forever, and that could, I think, lead to even social issues. But the fortunate thing is you've got in tandem to that lots of and other alternative investment products that have evolved, and a mentality shift as well of looking for convenience, looking for flexibility. So kind of recognizing that you're basically owning is sometimes renting from the bank, and you're tied into a home. There was an interesting article in The Economist, maybe I think it was around 2020. It was right around COVID, that talked about how housing policy has been responsible for, and the sort of putting home ownership on a pedestal has been a detriment to GDP growth, because there's a lot of friction in moving. And so if your highest and best use, or you could be more productive or better paid if you were to move to a different city, if you own your home, you're less likely to move. And so, and
the knock-on effect of that.
And when people own their homes, they wind up becoming more NIMBYist and preventing the development of more homes. And so there's just not supply for people to come into where the jobs are. And so that has had a drag on GDP at a surprise. I mean, if you'd have to read the Economist article, I think it said something like the 3 or 4 main cities in the U.S., if they were to able to build all of the housing that they would need to satisfy the job demand, GDP growth in the U.S. would be 4% higher, which is I think that's the statistic, and it's a meaningful one. So yeah, the middle income renter is a growing part of the segment, the demand pool. It's the largest and fastest growing segment. And so what we're doing is basically just a back to basics, what do people want? Where do they want to live? And delivering a product that they're happy to pay for. I think you don't need pet spas and golf simulators to attract people. They just want to, affordability as the new amenity, effectively.
Yeah. So where, we've spoken about a couple of different geographies or cities across Europe. Where are the kind of the high conviction areas for you? If you were to kind of rank top of the tree, what does that look like?
Yeah, so we do student housing predominantly and regular way apartments. In both cases, we focus on affordability. So in student, we focus on domestic students as a market that we want to make sure we're affordable to, and
rather than being reliant on Chinese
on international visas. Yeah. And sometimes we benefit from those, but we want to make sure that as a kind of foundational principle, we're affordable to domestic students, which makes the strategy that much more resilient. Today, because of the viability issues I described in the UK has become a little less attractive, or that there may be an evolution there, which we hope will happen. But whereas we were 40% of our fund previously was invested in the UK, I think that might be today, wind up turning into less than 20%. So our key conviction markets, to answer your question, are on the residential side. We really like Germany today, whereas we could not make it work before. Today, there's a universe of opportunity that has opened up there. A lot of it's standing stock. Again, this is a situation where units are being legislated into obsolescence, and owners have been under renting units. It's been a little bit of a not very active ownership market, and they're now being required to make investments, capex, into these assets to get them up to modern standards and to achieve kind of EPC ratings. And so there's an opportunity both to make those capex investments and also to just kind of fine tune the rental management and optimize revenue. So I think Germany is a really interesting market, and today, where you're able to buy standing stock in the kind of low to mid 4s. Before that same stock was upper 2s to low 3s, and so there's been a massive repricing that has opened a window of opportunity there. So Germany is high on the list. Stockholm is super interesting to us. So the for sale market has softened a bit. There's a incredible effort that's required to take projects through planning in Stockholm. it can take 8 to 9 years. And so you have a situation where often home builders will option land because carrying the land for the duration of the permitting process would be untenable. So they option land, they make the investment of time and dollars into, or euros into, or kroner, into getting the permits and planning. And then they're reaching the end of these options and they have to exercise them or lose them and lose the investment that they've made. So they're looking for kind of a trusted counterparty to do deals with. And in Stockholm in Sweden, EQT is a well-known name and a very trusted counterparty. So we have a really interesting universe of opportunity in Stockholm. There's also a massive supply-demand imbalance there. It's not true for all the markets in Sweden, but Stockholm in particular, there's about a 9+ year waiting list for apartments. So yeah, it's striking. And there's a fairly complex regulatory regime for rents there, which if you don't understand it, can kind of scare people away. But in our case, we have people who've done this across thousands of units and really know the ins and outs of it. So it becomes kind of a competitive moat or a bit of a superpower. And so we really so for Resi, it's Stockholm, it's a number of markets in Germany, and then Madrid, actually where I live. Last summer, they introduced legislation recognizing that there's more need for affordable housing, lowercase a, affordable. They introduced legislation that allows for tertiary land, they call it, so it's kind of commercially zoned land, to be repurposed to residential if you hold rents 10% below market for 15 years. And when you look at the market and the kind of product that we're designing and delivering, we are naturally priced below the market. So because we're lightly amenitized and we're really kind of targeting affordability, we're able to, so it's sort of like tailor-made for us where we would be doing that anyway. So that has opened up a universe of opportunity in Madrid that we really like. So we've got an interesting pipeline there. And then we have been keeping our ear to the ground and think that same kind of legislation might be introduced in Valencia and Seville. So we're kind of front-running opportunities there. So those are the three kind of Resi markets that I think are most interesting. And student housing, it's really Spain, where we've done it very successfully before, and I'll maybe tell you a little bit more about that in a second. And France. I mean, they're just in student housing. You look at provisioning rates, like number of beds per student, and there's just a massive deficit of housing. And every academic year, you start reading in the newspaper stories about students deferring admission or matriculation because they can't find housing, or they're sleeping in their cars or chemistry labs. I mean, it's a huge
Madness.
problem. Yeah.
Yeah. Expand on the Spanish opportunity then.
First of all, the provisioning rate is very low. So there's just a huge need for housing. As the Spanish economy has been thriving and wealth has been building, there's also a more interest and ability for the local market to afford student housing. And so I think that's, the domestic demand has been surging. As an example, we had 1,100 beds in Seville. It was one of our largest projects. And 90% of the residents in that project came from an hour drive of Seville. Wow. So super domestic market. So we're, our kind of affordability targets are in student housing looking at like 400 to 500 euros a month. So it's eminently affordable. The universities are also much more affordable than they are in the UK, and certainly relative to the US, which is a totally different story. But one of the things that we saw, and this is a point that I wanted to come back to anyway, was kind of synergies across the platform. So we've seen an increase in English language degree programs in some countries. In Spain, for some reason, there's actually been a decline in English language degree programs over the last several years. So our infrastructure team, seeing an opportunity there, went out and bought in one of the infra funds last year the largest private university system in Spain. And so we are super excited about this now because we did a very successful portfolio of student housing already that we round-tripped and exited last year. So we kind of know the ins and outs of the markets and where works better than other places and how to kind of fine-tune the design. And now we own a university system. So you can't imagine, a better sort of way to anticipate demand and see around corners than, kind of locking arms with our colleagues on the infra side and saying, okay, where are you going to add English language degree programs? Where are you going to expand the campus? Where are you going to add master's programs? And where do you need housing?
Yeah, it's one of the benefits of being in a platform that has got multi different sectors, or being able to own different parts of the value chain rather than just a single track focused real estate player that's all they do. There's benefit to having a private equity arm, VC arm, infra arm, etc. A question I ask everyone on the podcast is, if I give you £500 million worth of capital, who are the people, what property, and which place would you look to allocate that capital?
Naturally, I would say to our team and to the markets that I just
and
described.
Your strategy and the places you've got high conviction on. Yeah.
The honest answer is, I think Europe today broadly is super interesting. And when you look at things on a global basis, I don't know that there's a market that has the depth, the fundamentals, and it's just sort of all of the tailwinds that Europe has today. So I would say, yes, Europe kind of wins the day. And then within Europe, I think let's say if I had 500 million to allocate, I would definitely look at value add. I would look at living, period. I mean, I think living, regardless of what happens economically, there is a fundamental need and a chronic and such a pronounced supply-demand imbalance that I just don't see any kind of long-term. I see so much potential and downside protection. I mean, we had a fund that our prior vintage. We began investing and living in the middle of COVID, in the middle of 2020. We suffered through COVID, inflation after COVID, interest rate hikes, the Ukraine war. I mean, the most kind of toxic mix of headwinds that you could imagine. And so it's really been a story of performance through extreme volatility. And I think it's because we're in the right sector and it's demographically driven, it's economically influenced, but the kind of underlying demand is demographically driven. And so, yeah, long way to answer your question, but I would say living for sure would be part of it. I think the logistics market still has a long way to run here too. And, if I were allocating, I would probably allocate some to logistics. And, we have a logistics business. So, so my colleagues on that side of the business, I'm sure would be happy to hear that. And, and then the other thing that's interesting is we have, we didn't talk about it at all, but we have a self-storage business that sits outside of this. And I think the self-storage business has an enormous amount of potential when you look at, again, sort of how, the awareness of self-storage, which is just gaining some ground, and the amount of self-storage space per capita, and looking at consumption trends and looking at the affordability of housing and the sort of need for more space as an extension of people's living space and the way we're approaching it. I think that's a super interesting business. So I would put some money there.
Well, Tom, thank you so much for joining me on the podcast today and sharing a little bit about your background journey and the career that's taken you across 11 different countries, jurisdictions, asset classes, and I'm excited to see what you and the team go on to do at EQT Real Estate.
Thank you very much. It was a pleasure.
Hey, quick one from me. If you enjoyed this conversation, do me a favor and share it with a friend or colleague that you think would get value from this conversation. It would mean the world and help grow the People Property Place podcast. Thank you so much.